Hi, everyone. I'm Jessie Lam. I'm from Brink. We're a hardware platform in Hong Kong based out of PMQ. So a lot of you are today with your booths, you're demoing your products, and you're meeting a lot of distributors. And one of the things that you might also need is funding, as Atin just was talking about and had a great speech. So I wanted to give you guys a little bit of advice about what are some of the common mistakes that startups have made, and also what is that like from both an investor point of view as well as from a founder point of view. So a bit of background. So Brink is an end-to-end hardware platform. We help startups connect with other entrepreneurs. We also can accelerate them through a variety of products. So hardware is our vertical. And then we can also help them make the product themselves. So we have offices in both Hong Kong, in Shenzhen, and Guangzhou as well. And then last, and the one that I'm most excited about right now, is our growth opportunity. So recently we've actually teamed up with the Guangdong government and as well as Alibaba, and we've launched a program that kicks off on Monday. So we've been busting our butts about it. But basically it will help hardware startups sell to China, right? And that's something that even Apple or Google, like a lot of the Western large tech companies, hasn't done well. So what are the chances of you, a hardware startup, being able to do that in China? Well, if you have the right partners, if you have the right distributors, if you have Tmall or Jingdong in your back pocket and they're funding you, the Chinese government is rooting for you, then you're just increasing the chances that you will be successful selling to 1.6 billion people in China, right? So I'm super excited about that program. It kicks off on Monday. If you guys want to find out more information about it, you can come to our website, brink.io. BRINC.io. And I think that's something that a lot of the people in the audience today, because you're here at Global Sources, it's something that you're definitely going to be interested and will be helpful to you. A little bit about myself. Why am I talking to you about this? Well, I am a founder. I previously was a banker for about 10 years. I worked in valuation. I'm from New York originally. But then I kind of switched over to the tech side recently. I'm a founder in clean tech technology, and I'm also a CPA. So now I have a lot of due diligence. I do a lot of like the data room analysis that Atin was talking about, going through your financials, making sure your legal entity is set up properly. Are you someone that I want to invest in, right? And to his point, make it easy. Have all the documents there, have all your trademark, your registration all in line. Make it easy for your investors to write that check. Right? Don't make them try and scramble and figure out, oh, this legal entity owns the IP, but then that's 100% owned by this China legal entity, right? Like, make it easy for people to say yes to giving you money. So I'm going to kind of start off. There's 5 tips I'm going to go through really quickly. Some of it actually is an overlap with what Atin was saying from Q Ventures, and that just means us from the venture capital world. We kind of believe in the same things, and we're looking for the same things in you. So number 1 is build a business, not a product, right? As he said, don't be a one-hit wonder. Don't just create something that's in Sky Mall or QVC. You want to build an entire business and have a financial plan around it. How do you have different revenue streams? How are you going to scale? Which markets are you going to enter into? And in order to do that, you're going to probably need more than one founder. You're probably going to need someone that's on the business side and someone that's on the tech side. And you need to identify who are you in this scenario and what stage are you in. The biggest thing that you can do for yourself is to basically make it easy. Make your story easy to understand, right? Show your vision, articulate it well, and then people will want to invest in you. If you can't articulate that story, no one else is going to understand it. Everyone's just going to be like, okay, here's a wearable, I can play with it, that's nice, but that's not someone I'm going to give $100,000 to necessarily. So one of the biggest reasons that people, that startups fail is, and this is by CB Insights, is that they don't identify the market need, right? So when you're building a business, you're understanding what is the product, what are the pain points of your customers. And people skip through this all the time. I'm pretty sure 80% of this room has skipped through this, right? They're just creating the product. They want to get something. They want to get a USB drive or a battery pack or a wearable. And that's fine and that's great, but that's not a business. And that's ultimately, you're going to be that one-trick pony. You're not going to have an investor. It's not sustainable. What's the viability for you on the long term? So identify what that problem is and become obsessed with what that problem is, right? If you're trying to solve issues for someone with asthma, interview 100 people with asthma, right? Not your mom, not your dad, strangers, focus groups. What does it mean? Does that mean when they wake up, they have tightness in your chest? Is that something that your product can help address, right? Know those intimate details about them because these are the people that are ultimately going to be paying money for your product. I think in that case, a lot of people have seen this before, and this is not new. This is not by me. This is design thinking, right? So what are the 3 things that can help you with innovation? And number 1 is desirability, right? Desirability. Does your customer want it? Does this solve a problem for them? Will they pay money for this? Number 2 is feasibility, and that's a lot of what we're obsessed with in this world, in this room. Technically, how do you do it? What is your electronic schematics, right? Operationally, financially, supply chains. This is kind of like everything that everyone is more into, and then they forget about desirability. And then last, and this is what I always, because I'm a finance person, is your viability. And your viability is your business sustainable in the long term? Is it profitable? Do you have revenue streams that make sense? Don't just think B2C. Don't just think, oh, I'm going to have my product in a store and I'm going to sell it to a customer, right? It could be B2B, B2B2C, B2G. We have a lot of drone companies in our portfolio, and all the drone companies are actually focusing on B2G, B2 government right now. And that's a great resource for them. So you kind of have to think outside the box, right? So this is where the innovation is coming from. You need the juxtaposition of all 3 things to really innovate. And I'm just going to go through a really quick example. I want to put it out there that I'm an Apple fangirl, so this is not dissing on Apple in any way. But so in 2007, that was the year that the Apple iPhone was announced. And in that year, the Nokia 2600, this gorgeous candy bar cell phone up here, was the #1 selling cell phone in the world, right? The candy bar, you know the shape, you could throw it against a wall, it'll still survive, it won't get scratched, there's no glass screen. In this case, this fancy one had a colored screen, which is pretty innovative for that time. Well, so later that year, Apple introduced the 1st generation iPhone, and that blew everyone away, right? This is literally the juxtaposition of innovation. You have desirability, feasibility, their supply chains were awesome. They had Foxconn in their back pocket, and they had viability, obviously. They sold millions of iPhones over the year. And that was great, and that was innovation, and that was cool, and there's multi-touch, and you can scroll, and you can expand on pictures. Keep in mind, in 2007, this was all very new technology to us, okay? Well, so this year is the 10th year anniversary of the iPhone, and everybody was really excited. I was fangirling out. I know I'm in Asia. I stayed up until 3 a.m. to listen to their announcement, right, live, and they announced the iPhone 10. And that was great, and everyone was really excited, but honestly, it was a little bit of a letdown, right? It felt like an improvement and not innovation, right? A lot of what they have, like what do they have? They have facial recognition. Samsung has that already, right? They had dual cameras. Huawei has that already. So it wasn't that the technology was necessarily new, but more so that they improved on it. They kind of just made things a little bit better. Apple's great for its design, its entire ecosystem. It plugs in with your Apple TV or your MacBook. It syncs with your watch. So a lot of that just kind of seemed like it was an improvement on something that's already old. So in terms of innovation, I mean, I'm sure it's still very desirable. Everybody's still probably going to buy it on December, when it launches. In terms of feasibility, it got delayed, right? They announced it in September, but it got delayed until November. Why? Supply chain. Samsung, their biggest competitor, is supplying their OLED screens, right? So in terms of feasibility, from the technical perspective, they had some difficulties. You see a little bit of a kink in their armor. And then last, viability. Well, it's still profitable. They're still going to make a lot of money on it. But what that means is the iPhone is now over $1,000 US, right? In order to make it viable, to make the revenue streams that they needed to increase the price. And at the end of the day, that means they may lose some customers that might not be able to afford over $1,000 for a cell phone. So you'll see at one point they had hit the innovation, and then now they're probably going to have to come up with something new to really wow us in terms of the next step of innovation. Which brings me to my next point. Target the right investors. And again, I know you talked about this, so I'm not going to go into it a super lot, but I see a lot of startups waste a lot of time, right? Why are they wasting time? They're wasting time because they're targeting the wrong investors. Originally, I was going to go through these one by one, but you know what? Family and friends and fools, I love that, okay? The 3 Fs. Basically, don't waste your time. Like I said, do soul searching, right? Identify what it is that you need. Identify what stage you are in. Are you early seed? Are you at a bridge round? Are you Series A? Identify what kind of traction points you have. And then understand who those investors are. A VC is not going to be looking at you when you only have an idea on a piece of paper. If you don't have, works like prototype, right? If you haven't gone through DFM, if you aren't manufacturing. So understand what their goals and incentives are. Your mom and dad, goals and incentives are a lot different. I know even my dad, when he gave me money to invest in my first startup, asked for a business plan. My own father, okay? So, I mean, there are different things that people are going to need, right? Like angels, they probably only have about 2 rounds, the seed round and maybe the bridge round, otherwise they get priced out, right? Like you're too expensive for them. So they want to get in early. They want to believe in your vision. They want to see that you're the type of person that can carry this through to the next 5, 7, 10 years by the time you scale. Crowdfunding we'll get into. There's a chip on my shoulder about crowdfunding, but crowdfunding is basically a marketing campaign. And then you have VCs, and we'll also talk about that, the venture capitalists. I guess I am one now, so I can't diss on them too bad, but you know, we could talk about that a little bit more. And last is corporates, and this has been really interesting. So a lot of corporates have come in, CVCs in particular, and they want to get in on the ground floor. They want to invest in your technology so that it can align with their main business model, because they understand they need to innovate, right? Like think about it in Hong Kong. In Hong Kong, everybody does real estate, retail, logistics. Well, how can they innovate? What is the type of innovations that you can bring? And they're more than willing to invest in you early. So this is a new kind of institutional investor that people can kind of start exploring. And then I think this is probably the most important part, right? As a startup, be scrappy. Okay, there's lots of different ways that you can creatively fundraise. One of them is through accelerators. I happen to run one at Brink for hardware companies. What do we give you? We give you a mentorship network across the world. We can get you guys to talk to Fitbit or Pebble or whoever you want, Apple, Google. We actually have representatives from all of those companies in our accelerator. Investor network, same thing, right? Like these are the type of investors that know that an accelerator has already done maybe 50% or 80% of the due diligence for them. So they trust the type of integrity of the startups that come through us. Also, we give you cash. There's a check. I know we give you 130,000, other people give you different amounts. Cyberport has great incubation. They can also give you office space and money as well. So, and expertise and education. So accelerators are a great way to raise some money in the early stages. Another one that I mentioned before are when you're interviewing those people that have pain points, when you're interviewing those 100 asthma sufferers, ask them, what would you be willing to pay for this product? If XYZ can solve ABC problems, how much would you be willing to pay? And then if they say like $100 or whatever, hey, why don't you give me some money so that I can go solve this problem that is hurting your life? Right? I can help improve your quality of life or asthma through this XYZ product, but I need funding to get there. These are the type of people that will have much more buy-in and incentive to see your company come through and become a reality. I think this is actually the perfect place to talk about the third point, is basically to de-risk hardware. Hardware is hard, blah, blah, blah. To de-risk it, you can try and test the market first through white label products. And that means matching up with an OEM or ODM manufacturer, and I've saw tons of them there when I was walking the ground, right? Figure out what is your unique value proposition, and then you can just take the guts. The guts of it, it could be an air purification thing, or there was lots of cell phones or wearables. I know wearables are kind of old. But like you can basically white label that, put your software technology, your firmware technology on top of it, and then de-risk that. Eventually, 2.0, by all means, build your own product. But that decreases the amount of investment that you need up front in terms of NRE, DFM, tooling, molding, things like that, so that you can test the market, understand your value proposition, and then move forward. So you don't really have to come up with your own built from the ground product straight out of the gate. It just helps you de-risk and push some of that money more down the line when you've achieved a lot more traction. And then last, this is something I've seen a lot more in the past, actually, maybe 3 years, and we've been doing this a lot with our contract manufacturers as well, is they've been trying to go vertical. They want to not just be dumb manufacturing, right? They need to innovate as well. And so a lot of them, or at least a few of them, and I know which ones are open to it, have been open to exchanging DFM engineering services or NRE engineering services in exchange for some equity in your company as well. So this means that you kind of have to be in China, you have to be talking to the right people, you have to be doing the right research. You need to actually be talking to a lot of the people out in the booths there if this is a kind of the route that you want to go down. Okay, so this is the chip on my shoulder. crowdfunding is not real funding. Crowdfunding is marketing, okay? Marketing means you're spending money, okay? You think that you're spending money to make money, may or may not be the case. What crowdfunding really means is that as soon as someone gives you money, you now have a liability, right? I'm an accountant, this is what I look at. You have a liability on your balance sheet. You need to promise them that you will deliver something in 6, 9, 12 months, etc. And now you owe them something, right? And so if you owe them something, what is your ability to actually deliver? This is your reputation. Okay, you don't have the luxury of brand equity. Nobody knows who you are. You're an entrepreneur. This is your reputation, right? Like crowdfunding sucks because a lot of people don't deliver. And that means that they're not going to invest in you the next time you have a crowdfunding campaign, the next time you raise a startup, right? Like even if it's in something completely different, why would anyone trust you? You failed the first time and you kind of swindled people out of, let's say, $1 million, you know? So in this case, don't crowdfund because you need the money. Crowdfund because you need the PR, the marketing, the buzz, it's a traction point, but don't do it because you need the money. You need to, in order to have a crowdfunding campaign, alternative means of funding, right? Angel investors, accelerators, self-funding it, friends and family. There needs to be alternative means. And so one of the ways that you can guarantee or at least de-risk the idea that you will be able to deliver on your promise is you need to be talking to your factories before your campaign. You need to understand how much is it going to cost? How long is it going to take? What are the steps that need to go into it? All of this research needs to be done before you start your campaign, because that's the only way you can educationally make an educated decision on how much your crowdfunding campaign goal is. Right? If you don't know how much it's going to cost you and you don't know how long it's going to take you, then you're making empty promises without having all of the facts. So you need to be talking to your factories. You need to be talking to almost everybody in this room beforehand. Go visit their factories. Go to China. Go to Huashangbei, right? Like these are the places you need to do if you're a hardware founder and you're promising something through a crowdfunding campaign. Otherwise, it's just a very public way for you to fail. This is just very quickly, don't commit to any large stock orders. In the first couple of production batches, it's going to be working out a lot of bugs and things in the manufacturing process, upping the QC. So just keep that at a minimum until you get to your third batch or so, because otherwise you're just going to be stuck with holding a lot of really bad quality stock. And then this is actually completely, I 100% agree with you, it's all about preparation for your campaign. Right? Actually, so we have Nick Ramil. He's actually spoken at Global Sources before, about a year ago, and he went into this whole crowdfunding campaign. He had 20 campaigns, 100% success rate. He's like the guru on this. So this is what he's taught me. You basically spend about 12 months. You build up your tribe. You build up your mailing list. Everyone's asking, how many people's on your mailing list? It should be something like 10,000 people, okay? This is all work that you're doing. You have to engage with them. What colors do you like? What features do you like? Email them, get them to take surveys, get them to do focus groups, right? Engage with that audience. Make sure that these are the first adopters that are going to be part of your tribe that's gonna spread more news about your word of mouth later on. Right? So you need to engage them. These need to be the people that are buying on your crowdfunding campaign within the first 24 hours. And that's how every campaign we've ever launched has hit our goal within 24 hours. And then what happens? You hit your goal in 24 hours, TechCrunch writes about you, Engadget writes about you, all the blogs write about you, right? We've gotten written up in the SCMP because one of our campaigns has gone viral. So then that's traction, right? It kind of just keeps rolling onto itself. But the first 24 hours are very, very important. And you need to do the work 12 months beforehand to make sure that 24 hours launches seamlessly. And quite honestly, if you don't hit that in the first 24 hours, you're not going to be highlighted as a Kickstarter, projects we love. That's like one of the tags, right? You're not going to get that momentum. Nobody in social media is going to pick you up. And it's very hard to turn that around in the next 3 weeks. You can pay for Facebook ads, you can, buy social media or whatnot, but it's very, very difficult. So it's all about the preparation beforehand. And then last is just research, right? Like have a financial plan. That's actually one of the reasons why some of these startups have actually failed. These are actually one of the 4 biggest crowdfunding campaigns in the world that have all raised $1 million or more, or sometimes $8.5 million, and then hasn't delivered. Right? They took $8.5 million and then didn't deliver a single thing to their backers. Like that's terrible. Like, and gaming consoles. There's a shaver here that shaves by laser. That sounds really cool. Like I would pay for that. But they didn't deliver. And why didn't they deliver? Like I said, it's all about the financial planning. They didn't do their due diligence beforehand to talk to the manufacturers and see the feasibility and the viability of them being able to deliver to their backers. So this is a little boring, but I'm going to give you something free at the end. But basically, how to avoid poor financial planning, right? Know your BOM, right? Your bill of materials, how much your component costs, right? How much do they really cost? How much do they cost in China? Not how much when they cost on DigiKey, okay? Don't like, that's the Western price, that's the markup price. There's probably like 4 different vendors in between. How much does it really cost? What's your MOQ? Talk to the factories. How much is it going to take you to do that first manufacturing batch, to set up the assembly line, all that NRE engineering? That takes time and it costs a lot, like about $250,000 to $300,000, depending on what you're producing. Understand your timeline so that you know your backers have realistic expectations on when they can expect your product. People get delayed and delayed and delayed, and then they kind of start losing hope that they're ever going to see the product that you're delivering. And then the last is ultimately, after all you've done all this research, create your financial model. And I'm saying this as both a founder and as an investor, this is something you need, right? Like, how are you going to plan a good business plan without a financial model? How am I, as an investor, going to give you $100,000 if you don't have a financial model, right? So if you've done all of this research and you've gone to China and you've talked to multiple factories, put that into a financial model. And if you don't have one, I built one already. It's in the Google store. You can have it. It's free. 10 years of banking experience plus over 50 years of manufacturing experience helped me build this model from my team, obviously. So you can get it at brink.io/cash. It's for free. You download it off Google. It's a financial model. It's just a template. You guys should build on top of it, make it better. You can ask me questions if you have any. But basically, it's targeted towards manufacturing. So there's a lot of things in there about your different engineering costs or prototyping costs or your NRE costs, your BOM, your MOQ, how much you need to keep enough product in your inventory. All of this is available for you for free. So if you're a hardware startup founder, I highly encourage you to at least download it. If you don't like it, tell me why so I can improve it. That would be greatly appreciated. So venture capitals. Okay, so I'm a new venture capitalist, so maybe I'm a little bit on like still the founder side. Venture capitals are all about exits, right? You have to understand what are their incentives, what are their goals, and how do venture capitalists get paid, right? And those goals may not be aligned with what your goal is as a founder. And that's okay. They're still going to give you money, but you need to go in with your eyes wide open. Understand the framework and understand that you are, in exchange for getting cash, giving up control. So what you guys are negotiating is how much cash are you willing to, how much cash is it going to take for how much control you're willing to give up. So this is a quick, this is not mine. I stole this from Type T Capital, but it was graphical and I liked it. And they said I could. So basically you have a general partner and they fundraise from limited partners. So once they have done the fundraising, then the general partner spends their time doing deal flow, scouring the world for the best investments, doing their due diligence, and ultimately within their investment committee deciding on portfolio companies to invest in, right? This is very high level. But when they get to the portfolio companies, what they want, and this is very key here, they want to monitor your company. Right? They want to, in the best case scenario, govern and steer your company as a mentor towards profitability. That's probably one of the reasons why you're partnering with them. They probably have great networks, have done this a million times before. You want their expertise, right? So this is not like, oh, this is just a big bad VC. There are very good scenarios on why this makes sense. But the reason why they want you to be profitable, because ultimately what they're looking for is an exit. And the exit that they're looking for, at least industry average, a great exit would be a 3x multiple. I'm going to show you why that is so hard to get and why most venture capitals, I think 80% or actually about 85% of the venture capital funds in the world actually doesn't hit that multiple. When they exit, they can return all the money that they got from the LPs and then distribute any of the leftover proceeds, right? So this is just very high level how this works. Well, I'm going to walk you through an example. And this is the math part, so bear with me, but it's so important for your company to understand this. Hypothetically, let's say I have a $100 million fund. In a very simplified world, let's say I invested in 10 startups, $10 million per startup, right? So if I have 10 startups, $10 million in each startup, let's say in scenario A, and I'm taking 25% of your company. In scenario A, all 10 startups exit at $50 million, which is unrealistic because almost half of them will fail. But in this scenario, all of them exit at $50 million. Well, if you have a 25% stake, what that means is you as a VC take in $12.5 million. $12.5 million, and you had invested $10 million originally, right? So if you have $12.5 million, 10 startups, you get returned $125 million on your $100 million fund. That's only a 1.25 times multiple. Right? Yeah, it's great. You made some money. That's great. You know, over 10 years and you made $25 million. That's not bad. But that's not what the industry is looking for. That's not what your LPs are looking for. Your LPs are probably going to be very disappointed at that. So alternatively, let's say scenario B. Same thing. 9 of your companies exit at $50 million, right? You're still getting $12.5 million per startup. But that 10th company exited at $1 billion. That's your unicorn. That's what everybody's looking for. Everybody was talking about this. Dr. Charm was talking about this. Your unicorn, right? Exited at $1 billion. You have 25% stake. You have $250 million here. So from your 9 companies, you get roughly like what, 110 million plus 250. So you ultimately exit at $360 million, right? That's great. On 100 million, that's 3.6 times multiple. Oh, you've definitely hit it. But this is the type of math that you're looking at in order for venture capitalists to hit their return. Right? This industry, this is what people don't understand. Like, I'm trying to simplify it, so tell me if you guys don't get it. But this is what they're looking for. They're not looking for you to be a nice revenue generating company. They need you to be $1 billion unicorn because that's the only way they're gonna hit what they're promising their LPs. If they don't hit it, what's gonna happen? The LPs are not gonna invest with them for their next fund, right? That's it. Like, they're completely dependent on their exits. And I don't want to say that as a bad thing. Obviously, capitalism, I was in banking, we want to make money, and that all makes sense. But you need to do that with eyes open. You need to understand that when you're accepting VC money, you're giving up a modicum of control. They want to have a board seat. They want to have governance over you. And therefore, they can overrule you. They can shut down exits that they think are not giving you enough free cash flow, right? So your goals as a founder and the goals of a venture capitalist may not necessarily be the same. They could be. Oftentimes they are, and they're good, really good venture capitalists. I know a lot of them. But sometimes they can diverge. And so this is kind of the things that, I'm not saying don't accept VC money. I think it's a reality of our industry. But do it knowing all of the facts, and do it knowing what you're risking as well. Okay, I think I'm probably running out of time. Anyway, you guys are in Hong Kong already, but you need to go to China. And I said this already. China is not just manufacturing anymore, right? China is not just components. It's not just product development. China is its own $1.6 billion market. And so now people are not only just coming to manufacture in China and then exporting it out to their home countries, which they still are doing, but they're also coming to China to sell, specifically as a marketplace, as in the second largest marketplace in the world, and it's definitely going to eclipse the United States. And I'm American, I can say that. So definitely coming to China has so many perks for that. And that's why for at least Brink, we have offices in Hong Kong, Shenzhen, and in Guangzhou. So in Hong Kong, we do a lot of the front office work, the development, the launching. We have access to all of the other Western countries as well. Shenzhen, we do all of our manufacturing. We have studios there, and we can help you manufacture, project manage it, quality control, de-risk, your IP protection, things like that. And then Guangzhou, obviously, for logistics and commercial distribution to the rest of China, because China itself is a marketplace. And the reason you need to be in China is this. You can't afford not to be here, right? It literally doesn't make sense. So I had our team pull up this quick example, and I am by no means an engineer. I think you guys know this already. So this is an inverter, which is a common component on a PCB board, right? This is something that almost everybody has. This happens to be a 6-pronged one, okay? DigiKey, Arrow, Farnell, 48 cents, $1.05, 54 cents, right? China, Alibaba, this is what my sourcing team can actually get this for me, 12 cents. 12 cents. The cheapest one here is 48, right? And think about that for every single component on your BOM. Think about if you can, best case scenario, cut your BOM by to a quarter, right? That's crazy for your margin. Now you can go retail, now you could go brick and mortar, now you can get more distribution channels, right? If you get more margin that way. You can't afford not to be in China. You can't get these, this is probably like a fourth party, how many middlemen upcharge this to get you to over $1 for this piece component, right? That doesn't make any sense. You have to be in China because that's the only way you can lower your costs. plan for success, obviously do your research, summing this up. Shenzhen, 90% of consumer electronics are produced here. So if this is what you do, if you're a hardware founder, you need to be in the ecosystem. You need to be here. You need to be in Huashan Bay and go look at the madness of it all. Understand the capabilities of China. And lastly, you need to be aware and do all your research, right? So I know I'm going over time. Sorry, I talk a lot. But anyway, you need to be in China. You need to do it because it's good for your own business. Don't do it because Chinese government says so or I say so or whatever. This is actually good for your business. Anyway, I'm here to take questions. I left my email in case anybody, needs to have other questions.
So anyone have questions for Jessie?
Went through a lot of information,
okay.
and I talk really fast.
Okay.
Yeah, so what's the current state of Brink's incubator program? Is there an annual or semi-annual intake, or is it on an ad hoc basis, or what's the deal?
Sure, so Brink actually has a few different acceleration programs. Thank you for helping me sell my company by asking the question. So we have a global IoT one, which is based out of Hong Kong, but it's actually virtual. So we have teams in like Croatia or Malaysia or in New York or Philadelphia, and we can incubate them anywhere in the world because 100% of our materials are actually digitalized. So when they need to, they come to Hong Kong. When they need to talk to their factories, they come to China. We give them office space and whatnot. But otherwise, they can do it in their home market. Just because we found a lot of our founders, they could be second-time founders, they're older, they have families. They're not really like Silicon Valley bros. They're not just gonna like uproot themselves and move to Asia necessarily. So we're trying to make it so that they can both get the education and resources that they need globally. So that runs twice a year, 2 batches. We just kicked off our second fall batch about 2 weeks ago. We have our drone program, which is in Barcelona. And the reason it is in Barcelona is because the Barcelona government is super favorable. They open up airspace. They actually block airplanes from flying within a certain field, and they let us just play with that airspace and test all the drones we need. We could like blow things up, we can take pictures, we can it's crazy, it's awesome. And then there's the Guanxi program, which Guanxi just means relationship in Chinese, and so we just launched that about a month ago. It kicks off on Monday, and that's basically to help Western startups learn how to distribute and sell in China, the ecosystems, the KOLs, the Weibo blogs, the crowdfunding platforms. A lot of that is pretty new to them, and so there's a lot of education. And then, of course, they pitch to the Chinese government, and Alibaba and Tmall representatives are going to be judges on the panels, so they get pretty great opportunity that way.
Do you think it's getting harder and harder to find unicorns?
Yes. I think in general that a lot of people have a lot of focus on unicorns, and I think a lot of it is that they want to disrupt the market, right? I think there was one that I was hearing about last week. They're disrupting the funeral service market, right? That's something it took a lot of work, it's a lot of labor, it's transporting dead bodies, it's coffins, it's things like that. So everybody's just trying to find the next market that hasn't been disrupted yet or touched yet, and trying to change that into a unicorn. I think it makes a lot more sense, which is what we're doing, is focusing less on being a unicorn and being on a viable, long-term, profitable company. And I know as a venture capitalist, I'm probably saying the worst thing possible. But again, I'm not a very traditional venture capitalist. But yeah, there's a lot of emphasis on it, and there's actually a lot of pressure, even from the Hong Kong government. I was at a presentation by Fannie Law last week. Dr. Fannie Law was there last week, and from the Hong Kong government's perspective, they're like, we're investing in startups because we want more unicorns in Hong Kong, right? Like that was a KPI for them, So it's definitely top-down type thing.
Another question on that is it's getting much easier to be acquired. I mean, it's getting much harder to do an IPO. Yeah.
I definitely see an exit for most of our companies to be more M&A and rather than IPO. I think it's it's not too difficult. I mean, obviously it has happened, but if you're looking at hardware, if you're looking at new technology, a lot of times more, not even Apple, not even Google, but the cookware company is going to want to buy you so that now they can make their cookware smarter, right? Like Toys R Us was buying a lot of education platforms so that they can now manufacture educational toys that have that sing and dance and have AI and like whatever in it, right? So it's seeing a lot more of those traditional companies taking mergers and acquisition deals for some of these tech startups, just to be able to integrate those technologies into their own traditional company.
And last question, is there any feature to ICOs?
We're really on the ICO thing. Okay, so again, not speaking from Brink, speaking for me personally, I'm involved in an ICO project, and the one that we're working on, and I'm just going to give you a really high level, is basically to be have asset-backed currencies. So in this case, it could be something like a concert ticket, because when you purchase a concert ticket, Ticketmaster has a very sophisticated system so that you can buy tickets and you get to keep that in line, and then you have 10 minutes to execute and your credit card and whatnot. And so those are things that are very short in duration. Once the event is over, there's no longer an asset, but you need a record of proof that you bought that ticket at that point in time. So that's something that I'm not going to go too deep into, but yeah, we are looking at it. It's in its infancy. I think a lot of people said there's bubbles. There are going to be bubbles just because people are hyping it, but that doesn't mean that it's not good technology. It's just that needs to be implemented eventually in a nice, regulated, normalize it, right? That people can actually use it. It's much easier to transact that way across borders, no fees, no FX change. There's just too many great things about it that if we can just make it into a real grown-up technology, instead of a wild, wild west technology, that there's just infinite amounts of possibilities.
Yeah, something of value behind it.
Yeah.
Any more questions?
Okay. Thank you, everybody, for your time.
Thank you very much,